Dear friends, welcome to PMS Insights. As the COVID wave spreads across India, we hope you and your family are safe and healthy. While the virus spread is still persistent across India and the world, the global equity markets have bounced back strongly from its March 2020 lows. The Nifty index, which has bounced back 40% from March 2020 lows, has still underperformed global markets, with MSCI World Index trading close to all-time highs, led by elevated liquidity measures and global recovery in economic activity. Even in India, which has been marred by widespread COVID infections and a series of lockdowns, there have been green shoots, with many economic indicators indicating higher level of activity, especially in the rural areas. The data from CMIE shows a sharp drop in unemployment rates from around 22% in April-May to as low as 10% in the first week of July. The government support in terms of Manrega scheme and PM Garib Kalyan Yojana to the rural areas is expected to prop up the economy in this downturn. The key message here is to remain invested in good businesses even in times of uncertainty, as markets moves tend to be extreme and sharp, which might not be a true reflection of the underlying fundamentals. Even after this rally, we find value in companies including mid-cap names, which could deliver strong returns over the next 2 to 3 years. While the large-cap indices are just 10% lower than their all-time high levels, the mid and small-cap indices are still lower by around 30 to 50% from their all-time highs seen in January of 2018. Also, a few other indicators like yield gap ratio, market cap to GDP, etc. continue to point towards healthy returns in equities in the medium term. The yield gap ratio is the ratio of dividend yield on equity to the yield on the long-term government bonds. A higher ratio indicates that the equity is attractive and underpriced related to government bond yield. Currently, it is at around 0.8, which is close to its long-term average and attractive versus the last 6 years average. The market cap to GDP is also close to its long-term average and does not indicate any bubble in equity markets. Coming to the financial results for the fourth quarter of FY20, as expected, corporate earnings print was weak. Only select companies in consumer staples, IT and healthcare sectors have reported year-on-year growth apart from a few companies in other sectors. While the recent corporate commentary has been positive post the opening up of lockdown, especially in non-metro cities, the sustainability of this positive trend depends upon the localized lockdowns being removed soon. Select sector portfolio companies delivered in-line results with earnings hit ratio coming in at 73%, which means 73% of companies delivered results either above or in line with estimates, and remaining 27% companies missed estimates. Average revenue and EBITDA growth for the portfolio was around 1.3% and 13% respectively, versus minus 5% and minus 19% for the benchmark. New additions to the portfolio include Mayur Uniquoters, Navin Fluorine, IIFL Wealth, JK Lakshmi, Metropolis Healthcare, and Ajanta Pharma. Most of them have positively contributed to portfolio performance. As seen in the table, 8 of the top 10 holdings in the portfolio have outperformed the benchmark over the last 1 year, and earnings growth outlook is improving as we go ahead. Low-ticket consumer discretionary items and consumer staples are expected to do well as people stock up on essentials and spend on daily necessities. Select companies in the pharmaceutical space are also expected to do well as the price erosion in the US has stemmed and the demand prospects both for US and Indian pharma markets look decent. Cement space continues to have the benefit of resilient demand, pricing discipline, cash flows, cost advantages, and reasonable valuations. Our portfolios are appropriately positioned in these sectors. In line with our investment philosophy, the net profit growth for the portfolio is at significant premium to the benchmark on FY22 basis. We expect companies with management pedigree, conservative and strong balance sheets with high earnings growth visibility to benefit in the near to medium term. While the near-term business environment is reliant on the discovery of vaccine for COVID and how fast the economy bounces back, the long-term growth story of India remains intact. Thank you.